Rupen Rajguru joins us on the show. He is, of course, the head of equity investment and strategy at Julius Baer. Hi, Rupen. Good to be speaking with you. To begin with, what's the market telling us in the sense that there hasn't been any incremental negative news flow as such, but it's not taking off? Do you think the interest in the overall markets is on the lower side, or is it just time-wise consolidation that we'll have to deal with?
Okay, hi. Good afternoon. And as you said, what is market looking for? So while you said that there is no incremental negative, but at the same time there are no incremental positives. So usually, we had this phenomenal bull run between 2020 and 2024, wherein the earnings compounded more than 20% plus for large caps and 25% plus for mid caps and 30% plus for small caps. So now, while other things remaining constant, what we are clearly seeing a slowdown in earnings, and that is also getting reflected in the market prices. So to answer your question, I in the near term, earlier the theme for the market was catch everything which was moving. Now the theme would be consolidation, because earlier everything was moving up, earning was going strong. Now there will be differentiation between, there will not be a wide across the board earnings growth. There will be pockets which will show growth, and which is where the market will look into. So in the near to medium term, we expect market to consolidate, and probably we are at say 24,100 level, which is kind of the fair value, closer to the fair valuation zone. And market will probably take a breather for a quarter or two till the earnings catch up happens, before it sets its a new leg up journey.
So clearly, earnings growth is the only key trigger based on which the market could move higher, as per what you're saying. But could you tell us that by when do you foresee that there could be a strong or a solid earnings growth? Could it be in the second half of this financial year? Could it be in the FY26? Because for second half, at least there are multiple triggers, given the fact that monsoon has been good. There has been some pickup in the rural market. Festive season was pretty much on expected lines, plus government capex is also expected to pick up in the second half.
Yeah, you are. No, while I just want to add to what I said, while earning growth determines the long-term trajectory of the market, the very short-term, two other factors, sentiment and liquidity, determines the market. So, case in point, like last Friday move was purely sentiment-driven, because incumbent government coming back with a thumping majority, and then market gave a thumbs up to that. So all these daily triggers will come and will impact the short term, but over long term earnings is what determine. And to answer your question, we are probably witnessing a cyclical slowdown, so it is not a structural slowdown. What are the reason why earnings is low? One of the key reason is government spending has come off. For till October end, they probably only have spent 40% of their allocated capex for the year, and we expect that to kind of accelerate now going forward for next few months. The other thing is the banking system also, to some extent, engineered by RBI. The overall credit growth was also slower, which probably will remain a little bit slow. But both of these factors, we believe, will kind of change. And you are absolutely right. As we progress and more towards the fourth quarter is what we believe the earnings will come back. So from a overall Nifty's perspective, when we began the year, and between now and the consensus expectation was around, say, 14-15% growth. As we stand today, for the first half, the growth has been hardly 2% or so, and we expect for the full year the Nifty earnings growth would be closer to 8 to 9%. So definitely we will see the glimpse of that happening in the third quarter, and more so we will see in the fourth quarter.
Those sectors where we can see a solid earnings growth in FY26 and valuations are also reasonable at this point of time?
Sector wise, one sector, I think two, three the themes I will talk about. One clearly is the private sector banks, the large private sector banks, barring one, from a pure stock market perspective, have been a big underperformer for now 3 to 4 years. the earnings growth actually has not been as bad as what Street has been anticipating for the large guys. While in this quarter we saw stress across MFI and unsecured lending, but for some of the large private sector banks and even the largest PSU bank, the earnings growth has been pretty good. The credit quality has been good. So there again is where we believe from a valuation as well as earnings standpoint, there are opportunities in the current market. Secondly, in the current scenario where the globally again, once we get into January, we will see a lot of noise. As they say, there will never be a dull moment when Donald Trump is at the helm in the US, and now add to add Elon Musk factor, so there will be a lot of noise which we'll be seeing. But one thing is clear: the US economy, which everybody was earlier expecting either a hard landing, soft landing, probably it's doing okay, and in fact we expect the US earnings to be better than its long-term average. So the Indian IT industry, which earlier was being impacted by the discretionary spending not coming through, we expect that to be pretty strong. So IT as a sector also from next year perspective, after a very low base, we expect a very strong earnings comeback in the next year. And in the near term, to answer your question, considering the fact that there is revival of rural economy and a lot of spending, which now on welfare schemes is what government is doing. We have seen, one of the key reason why the governments are coming back is because of the spending which they are doing on the welfare side. So low ticket consumer discretionary items, be it QSR or be it footwear, be it movie exhibition, be it value retailing, all those we believe will see earnings come back because they have all suffered for last many quarters.
Right. And how are you looking into the cement space, given the fact that the capex is expected to pick up in the second half? Won't that sector also be a direct beneficiary of the same?
You're absolutely right, because one of the reason why cement volume growth has been tepid is because of the monsoon, elections, election related slowdown, and government not spending enough. At the same time, cement actually, the big war was happening wherein the top two groups were on acquisition spree. So what had happened, the pricing actually had collapsed. And in fact, our channel checks now indicate that this in November, especially in North and East, we are seeing the, a little bit of price hike coming through. So cement no, had a disastrous quarter too. In fact, their EBITDA per ton collapsed to $650, which is 650 rupees per ton, which probably is 25% lower than what it was last year. So we there also now price considering that the one of the groups which was very active on acquisition probably will now slow down, and we will see the volume growth coming back and a little bit of pricing discipline come back. So the 3 and 4 cement actually, if you ask me, will be one of the dark horse in the current scenario, wherein there is definitely a lot more relative value.
And how are you reading into the metal space, given the Trump tariffs that are expected to come in? Do you expect that sector to benefit out of that?
See, historically, metal has been a big, difficult one from a pure stock market perspective because of simple the China factor, right? For almost a majority of commodities, China is the 50% consumer, and for a lot of them, 50% producer. So the China factor, how is the Chinese economy doing? And once Donald Trump comes into power, the actual, we have been hearing so far the noise level on the tariffs. So we all are prepared for the worst. So if the actual is not as bad as it is, and then China then might again go aggressive on stimulus. So that factor can lead to positivity around commodities. But from our perspective, it's been a let me be honest, it's been a very difficult one to take a call on commodities. But to answer your question, in the near term, probably we might see some positivity around that sector.
You go, what's the verdict on the PSU sector, because it had re-rated and then consolidated a bit? Do you think it's closer to fair value now or has more potential?
No, Anisha, the PSUs, as you rightly said, from as a pack, they were valued, say, around COVID times, around 6-7p multiple, and some segments wherein the government focus was there, be it the railways, be it the defense or some of the PSU banks, they got significantly re-rated, almost as a pack from 6-7p, almost 20-25p. But I would say in the current juncture, I would want it to consolidate for a longer period of time. I would want the earnings to come through because the execution is an important factor there. And so far as the government balance sheet is good, the execution will be good because government have been paying them on time. But if there is a little bit of problem around that, we will see problem percolating down to PSU. To answer your question, at this current juncture, we are neutral towards PSUs because they have not come to that valuation which makes us seriously look into it from a medium to long term perspective.
Okay, point taken. On that note, we let you go. Thanks so much for making time and speaking with us today. But
if you like this video, then like, share and subscribe to ET Now.